You may have heard that Netflix just announced the 10-for-1 stock split, and the stock's trading around $1,100, up 25% this year and 48% in the last 12 months. But here's what I'm asking. Does that split actually make Netflix a better investment? Or is it all just smoke and mirrors? And of course, what does it mean for retail investors moving forward? Because I have to say, the timing is a tad suspicious. Netflix just missed earnings by 15%, dropping from an expected $6.89 in earnings per share to $5.87. That's a big miss. And it came right after a $619 million one-time charge that spooked Wall Street. So, what do you do if you're the CEO of a company when your stock dips? You give investors something to cheer about, a stock split, and then the crowd goes wild. But here's the truth, a stock split doesn't change anything. Well, at least it's not supposed to. I mean, let's say you sell pizza, right? You can slice a pizza into 10 or 20 pieces, but as a whole, it's still the same pizza. And Netflix's business has grown to 300 million paid subscribers across 190 countries, with a pipeline of original content that viewers love. But if you think that cheaper shares mean better value, you're missing the signal that I'm watching, and it's not the split. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That's a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/Ricko to get your 10 stock picks right now. Now, to most people, Netflix is the streaming giant where you can binge your favorite shows and movies anytime, anywhere. But here's something that many of us are forgetting, right? Netflix didn't start that way. It actually began as a DVD rental company back in 1997. And stick with me. The company's history has not always been smooth sailing. It's been hit by the massive dot-com bubble, and in 2000, CEO Mark Randolph and Reed Hastings, they even tried to sell the company for $50 million to Blockbuster, which then was the biggest company in home entertainment. Can you imagine? And that deal never worked out, never materialized, because the Blockbuster CEO thought that Netflix was a joke. I wonder what he's thinking right now, right? Well, fast forward to today, Blockbuster is now named BB Liquidating Incorporated, while Netflix has 300 million paid subscribers, over 190 countries, and the company name is an enduring staple in pop culture, right? Today, Netflix not only offers streaming services, but it also has its own studios, creates its own original films and series worldwide with several iconic productions like Stranger Things, Bridgerton, Squid Game, and even The Crown. And behind all that cultural dominance lies a stock that's been making some serious moves. And the question is, can the business behind your favorite shows keep outperforming the market? Well, let's find out. Netflix recently closed at around $1,100. The stock's up 25% year to date and around 48% in the last 52 weeks. That's a pretty big run up, but there is a catch, and it's a big one. You may have heard that Netflix's stock has recently cratered from trading at around $1,240 to where it is today. And that drop follows the release of its third quarter financials for fiscal 2025 on October 21st. And that was also recently brought up in my Discord channel. So here's what happened in a nutshell, right? Netflix reported 17% growth in revenue year over year. That's good. And it met previous guidance. That's good. But the company's bottom line missed expectations by a really big margin. And that's a problem because stock prices often move in line with EPS growth, not revenue. Netflix's reported earnings per share for the quarter was $5.87, while Wall Street expected $6.89. That's a 15% miss. And Netflix has done well in the past 3 quarters, so this came in as a pretty big surprise. Now, as I mentioned earlier, the earnings report pinpoints a $619 million one-time charge as the reason for missing the estimates. It's related to an ongoing issue with the Brazilian tax authorities, though Netflix assures investors that this will not affect future quarters. In plain English, that one-time hit spooked investors, but Netflix says it's a temporary headache, not a long-term problem. But it's a big reason why earnings season is such a critical time for investors to stay on top of the news. Because when a great company misses expectations, Wall Street doesn't flinch, it reacts fast, right? And that's what creates opportunity only if you're paying attention. And speaking of news, Netflix recently announced another big one at the end of October, a 10-for-1 stock split. Now, if you're unfamiliar, a stock split is when a company increases the number of its outstanding shares just by offering more to current shareholders while proportionately reducing the stock price so that the total value of each investor's holdings remains the same. It's kind of like cutting a pizza into more slices. You end up with more pieces, but the overall size of the pizza doesn't change. So the stock split is going to happen on Friday, November 14th after the bell. So let me give you an example, right? Let's say Netflix trades around, let's say it trades at $1,200 by then. And let's say you own one share of the stock. So your position is $1,200. Once the stock split happens, your one share now becomes 10, and that stock price becomes $120 per share. And of course, the market cap of the value of the company stays the same. And that's where most people stop, right, at the headlines. But this is where you need to look deeper. First, one share of Netflix stock just became more affordable, at least in a nominal sense. Instead of needing upwards of $1,000 to grab one share, you'll now be able to buy Netflix at around $100+ after the split. And this alone affects investor psychology, because even if the lower stock prices still come with the same fundamental value, I mean, if more people feel like they can finally own a piece of Netflix, even though the company's value hasn't changed, it means that more buyers are buying the stock. And this is liquidity and trading volume that adds up, and it tends to improve after a split. So you could say that a split is less about fundamentals and more about psychology. But what does this mean for the stock's future trajectory? Honestly, it shouldn't be anything, not much. I think the stock split will be met with some near-term excitement. And on top of that, you're going to have a lot of people talking about it, like me, which I think is good exposure. And if the stock does get a boost from the split, I think, though, I would warn that it's probably likely to be short-term. Because unless there's a drastic change in the company's fundamentals, or there's some big news between now and after November 14th, the overall stock performance will still be driven by its actual earnings, subscriber growth, market conditions, and speculation. In other words, a split can make the stock feel more accessible, but it doesn't create any actual real value. And that's the part that many investors forget. The price per share changes, but the business doesn't magically become stronger. And this is why investors need to focus on the business and the numbers, not the headlines. Because when everyone's chasing a shiny object, the real money is made by those that are watching the fundamentals. By the way, I'm going to be covering Netflix in a future video, including their next quarterly financials, as well as new news that comes out. So be sure to look out for it because, the next video could change the narrative on Netflix entirely. So with all that out of the way, is Netflix a buy at today's levels, or should you wait until the stock split? Well, a consensus among 47 analysts rate the stock a moderate buy with an average score of 4.26 and a high target price of $1,600, which is about $160 after the split. So it suggests as much as 43% upside. In a company this big, there's nothing to sneeze at. So you could say that the street is cautiously optimistic, bullish, but not euphoric. There are some risks involved, which I'll cover in the future. But what do you think? Are you taking advantage of the stock split to grab shares at lower prices? Or are you going to just stay on the sidelines or just watch the stock from your portfolio while you wait for future developments? Let me know in the comments below. And of course, while you're there, don't forget to like and subscribe because it helps others find the video, it supports the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today in this video. I want to thank you so much for watching, and I'll see you next time.